Hello and welcome to this week's webinar with me, David Jones, and Aondo Markets. So this is a webinar that we do every Wednesday on lunchtime on a Wednesday, and there are two parts to this webinar. It runs for half an hour, so we're done by 1 o'clock, and we'll take a look at the major markets, so indices, oil, gold, and some of the FX pairs to see what's going on, where the big levels are, where the trends are, where the opportunities might be, that sort of thing. But we also do a little session on strategy, and today's strategy session is going to be on moving averages. So we'll do sort of 5 minutes on that, using moving averages, how we can use them to maybe get into a trade, get out of a trade, all that sort of stuff, really. So you put the risk warning up. If my keyboard is going to work, there we go. I'll just leave that up for a little bit. So Aondo are maybe better known for follow trading, copy trading. And I do a webinar twice a month on that, normally on a Tuesday night. But you can also do your own self-directed trading as well. So where you decide yourself what you're going to buy or sell. So that's what we're focusing on today. Okay, I think that's been up for long enough, hasn't it? Let's take a look and see what's happening. Okay, so this is Aondo's trading platform. Let's bring up a chart. I think if we start off with we'll start off looking at euro dollar and pound against the dollar, because I think it has been interesting what happened last week and also to the end of last week. So let's start off with the euro first of all, because I think you could argue it's a buying opportunity down here, but let's just walk through what's been going on. So what we're looking at here, this is a daily chart of euro dollar for the year so far, and we had this this great trend, you know, where we've seen the euro run up off the April levels around about 106 in April, as high as almost 121. So that's, you know, near enough 15% rally by the euro within 6 months. But we've seen that stall a bit, and I don't know if we mentioned this last week. I'm sure I did. You know, but if you like patterns, potential head and shoulders, a shoulder, head, shoulder pattern in euro dollar. So we'd seen some of that strength stall a little bit towards the end of August, beginning of September, and then last week when we had the results of the German general election, we did see a bit of weakness euro last week. I think these three red candles, that was the week, but we did see it bounce back towards the end of the week. Then we started this week again with a euro under a little bit of pressure because of what's been going on in Spain with the Catalan independence vote and the resulting violence off the back of that. So we saw the euro start the week under some pressure. But I think it's interesting here because I think there's a couple of ways of looking at this. So you could take the view, okay, the trend line's broken, that's it, that trend is over, it's going to go down from here. But you know, the market doesn't necessarily know it's broken its trend line. And for me, on trends like this, you know, the most important levels really, which I'm sure I've bored you with before, you know, is that a major sort of previous highs and lows. And if we look at the major low going back to August, just before the market, you know, ramped up another 400 points off this level, it's 116.60. So that level is still intact. And I think maybe what's interesting from last week, we saw, let's flip over to the hourly just to look at last week in a bit more depth. I think what was interesting was last week we did see some stability coming in, sort of middle of last week, around about 117.20. The market managed to rally 100 points off that. Then we saw that weaker start on Sunday because of the Catalan situation, I think. But the market pushed below the lows of last week. But you could argue, you know, that it has been something of a false breakout. So we've seen last week's lows breached, but no real follow through. You know, all right, it spent sort of 4 hours below it, but as soon as the European session opened, or maybe yesterday, we have seen buyers come back in. So I think it's interesting down here. You know, if we flip back on that daily chart, personally, you know, so my view is this trend isn't over yet, as long as this sort of area holds, you know, so it's sort of a bigger picture view. As long as 116-ish to 116.60 holds, that trend is still intact. So that the logical target is for another run back up to the 121 area. So down here, sort of 117.70, I think it's an interesting trade from a risk reward point of view. I suppose if we were going to trade off the daily charts and trade now, we might have our stop loss somewhere down here. Let's say we go, let's say 115.75 to make the maths easier for me. So we've got 200 points risk from here, and we've got the potential for, in terms of risk reward, it's not a great trade yet, but we've got a potential for maybe a 350 point rally from where we are now. You know, if we broke it down into shorter term timeframes, we could maybe get better risk reward. But I think it is interesting how we have seen, you know, maybe the biggest run of weakness we've had in the euro since the beginning of the summer, but we are seeing these old big levels hold. So I think it's so for my money, you know, the expectation would be for the euro dollar to continue to stabilize down here and maybe have another push up at that 121 zone. But I think needs this 116. I think if there's a level to keep in our heads, then it's 116, I think, for the euro. And as long as that level holds, I think the bias remains up. If we take a look, let's take a look at the pound against the dollar. I think Theresa May started her speech, the Prime Minister, about an hour ago, maybe less than an hour ago, so I'm not quite sure. Let's have a look at the short term. Is that having much of an impact? No, is a quick answer to that. But pound against the dollar has been an interesting one because we have, you know, to remind ourselves, you know, we had the flash crash last year that sorted it down, depending on, I mean, whose low you take. I mean, there are lows below 119. The lows here, we don't have it. We have it around about 120. It's sort of, I don't think anybody's really sure where the low actually was. But I don't think that's important. You know, what's important is what's happened this year. You know, when we have had for this year, despite Brexit, the euro, the pound against the dollar, you know, has recovered. You know, so we've seen a recovery of about 10% this year. And it really rocketed, you know, just from August. It was gone from 128 up to 136.5, you know, so an 800 point move during much of August without leaving much in the way of support on the way down. Now, unlike the euro, the pound has remained weak. You know, we saw a big sell-off earlier this week. It sort of was finding some stability last week at sort of 133-ish, that's around 133.50, and we have seen it under pressure. But I suppose you could pick up on levels like that one, which is it's a little bit finger in the air level, but 130.150. So let's take a look on the hourlies. If we have a look on the hourlies, so I think there's some interesting stuff going on here, because I was thinking this morning about selling short, even though I don't believe that it's actually going to go down that much lower. In terms of risk rewards, I think it's interesting because so this is the second, this is Monday, so the market pushes lower, and then in the early hours of Tuesday, the market pushes lower again. Yesterday afternoon, 1 o'clock, pushed a little bit lower. So, you know, up until 1 o'clock yesterday, there's still a bit of bearish pressure, I think, on the pound. And for me, the thing that was making me think about maybe placing the trade was the fact that the market, you know, we haven't managed to take out the highs. You know, we've got the highs from yesterday morning up about 132.90, this whole 133 area. So I think it's going to be interesting to see what happens. You know, assuming these levels hold, it does look like, well, maybe we'll get another push lower, maybe down to 132. So I think for the pound, if it breaks 133, it does look like this run of weakness is over. But for now, you could argue for a really short-term trade, you know, going short at here, wherever we are, 77, with a stop somewhere above the highs for the last couple of days. It makes for an interesting short-term trade. But again, for me, you know, I do think, going back to the dailies, I think we've got the ability in the pound for the market to snap back and have a look at 136. I mean, clearly it was a heck of a move up from 128 to 136 in a month. It was always due some sort of unwinding. So for me, if someone said, where's it going to be the end of the year, I'd be more up here than down here, if that makes sense. But I think the next few days, or even this afternoon, you know, will be telling to see how it reacts in this whole sort of 132.70, 133 area. But you could argue it's a short there, and if it crosses above, then it's time for the recovery again. Let's see what happens. US stock markets. I mean, it is the same old US stock markets. We'll have a look at this, and then we'll have a look at moving averages. Actually, I always check to see what percentage of people are short or long. Let me just bring that up. So once again, I think the US markets defy anybody who's got a bearish view, defy gravity, and on the S&P 500, which is what we're looking at here, this is the daily chart of the S&P. It feels like just for the last week and a half, all it's done, I think, is just push out to fresh all-time highs every day with barely a sell-off. Here we go. I'm looking on another broker now. So out of clients who've got positions on the S&P, 78% of them are shorts. And this is what we always see. Whenever we get a market that's moving strongly one way or the other, people will bet against it. So there are a lot of shorts getting burnt at the moment. And I think it's been really hard to trade. You know, I've been trying to buy it and you're just waiting for a decent sell-off. And they just don't come. It just, you know, if we look at when the market really started moving through sort of 25.10 on September the 28th, whenever that was, you can just see these are hourly candles. It sells off a little bit overnight and ramps up the next day. We have a dip for 2 hours and off it goes. I mean, this really is just an incredibly strong market. As usual, you know, you could argue that it is overbought up here. Let's plonk an RSI on. So let's put our relative strength index on, and let's flip it back to a daily chart. There we go. So we've got, this is the most overbought the S&P has looked since February, going by an RSI since February of this year. Okay, so that's right, isn't it? Yeah, that is right. But you know, it's a market that's just incredibly strong. We haven't, I don't think yet, not in the overnight market, I don't think it's quite set fresh all-time highs just yet. But for me, you know, I've got an order in to buy if it goes back to yesterday's low down here, sort of 25.28, 25.30 area. But it's a market that's incredibly strong. And I'm saying that a bit begrudgingly because I've got an options trade on the S&P that runs out in November, and I could really do with it a bit lower than where it is now. But you can't argue with the momentum in this market at the moment. It's absolutely incredible. You know, let's pick up on some of the levels. You know, I think if you were of the opinion that, okay, the market is, you know, this is a market that needs to go down, I think at the very least you have to do yourself a favor and wait for it to start going down, you know, because it's a market that just continues to just burst out to new highs. You know, we've got levels, so many levels, little levels left, 25.28, 25.20, that the old top of the old highs up here, 25.12, then much stronger support, you know, running just below 2,500 from 24.90 through to 2,500. So it's hard to see a sell-off in the S&P being anything other than a buying opportunity. You know, we'll have a look at some moving averages in a minute on this, and we'll have a look at maybe in a bit more depth. But I thought, you know, it's a market that every week it's just doing the same thing. It will go sideways for a bit, then it will just ramp higher. You know, so I think it's a market where go short at your peril, you know, regardless of how overbought you think it might be. It's a market that's incredibly strong. Anyway, let's take a look. Let's have a little break from the old squiggles, and I'll do some squiggles of my own. So we'll talk about moving averages. Let me just draw on this screen. Let me just make sure you can see the screen first of all, and let's bring up a little bit of squiggle paper. Here we go. So the idea behind moving averages, I must admit, I don't use them that much, but if at all. But that doesn't necessarily mean they're a bad thing. You know, there are lots of different ways that we can carve up what we think a market is doing. But I think plenty of people, when they first start looking at market charts and stuff, moving averages might be one of the first things they look at because it's a very, I think, you know, popular tool in the investment world as well. And the logic behind it, or the theory behind it, is easy enough. Let's say we have a market that's doing something like that. There's our bars, and then it goes up. And then we have a moving average. Let me change the color to make it a bit clearer. And let's say we have a 50-day moving average that might look something like this. All the price here is, if it's based on closing prices, which is pretty typical, it just takes the last 50 days closing prices for a simple moving average, divides it by 50 to give you an average price for today. So by definition, if a market's falling, then the moving average here will be taking into account much higher prices. So in a falling market, if the market is here, then the moving average will be above the price. In a rising market, in a market that's been rising for a while, if the market's up here, the moving average will be below the price. And you'll see, of course, at some point, if the market changes from being in a downtrend to going into an uptrend, then the price and the moving average have to swap places. So at its real most basic level, this is at the trading signal. So the trading signal is when price and moving average reverse. So when, well, cross, I should say, sorry. So when the price crosses up through the moving average, that's a buy signal, buy signal. And when price, like up here, say if I just invent this thing up here, when the price falls below the moving average, that's a sell signal. Okay, so very simplistically, that's how moving averages work. You know, and I've pretended this is a 50-day moving average. Clearly, if you have a 10-day moving average, it will be much closer to the price. So it will track the price a lot closer. The downside of shorter-term moving averages, and we'll look in a second, is because they're closer to the price, they're much more susceptible to false signals. So you get a lot more chop where the price crosses above and then 2 days later falls below, and so it goes on. So the benefit is you get into trends quicker, but you're going to have more false signals. So what some people do to try and filter out this stuff, let's just clear the screen and start again. We've got our market that looks something like that, and they use two moving averages. So they might use a 50-day and a 10-day, for example. So a 50-day has a more leisurely approach to what's going on, and then we might have our 10-day that's tracking the price a lot closer, but the signal comes not from the price moving through the moving average, but from the two moving averages crossing over. And it does make sense, because if you're using moving averages, you're trying to smooth out a lot of the day-to-day or hour-to-hour, whatever the time frame is, noise of the market. So using two moving averages, you know, to generate buy and sell signals is a valid approach as any. But as usual, let's just take a look in the real world and see how this actually worked. So let's flip it over. So what we're going to do, we'll flip back to the trading screen. Here we go. Let's stick with the S&P. Let's go dailies. Now the thing is, the S&P, because it has been such a great trending market, I would guess that virtually most moving average approaches would have made money, because moving averages are a trend following system. So as long as the market is trending, they'll make money. Where they get absolutely chopped up is if you have a market that goes sideways. So let's scroll down through this never-ending list of indicators. Here we go. Simple moving average. That's the one we're going to use. So let's say, for example, so that's on there. Let me change it. Let me make it a 50-day moving average. Here we go. Purple. Purple is definitely a good color to use for moving averages. Better signals with purple. So this is how it works. So this is a daily chart. So if we track back, let's just zoom in. If we track, let's track back to here. Let's pick here this perfect signal. So the day before the US election, 8th of November last year, or the day they were all voting, you can see the price, the S&P 500 closed above the moving average. So that was a buy signal, a very simplistic buy signal around about 2150 on the S&P. Now, it faffed about the next day because we had that massive volatility, but traditionally, you'd wait. If you're trading off a daily chart, normally you should wait for the close. You want to see the market close above or below. So even though it traveled through the moving average during the day because of that overnight volatility when Mr. Trump got in, it didn't close below. So technically you've been a buyer here, and you're still long into January. It comes back down, but holds. The 50-day moving average doesn't get broken. And then the close was here. So you would only, if you're using a 50-day moving average on the S&P, you're a seller there. 26th of March, closes below. So you're out at about, I don't know, 23.30. So you've banked 180 points. Well done you on the S&P off your moving average. And then you see this is the point. This is where moving averages don't do so well. If the market goes sideways, so you're out that day, and you'd reverse, you'd be short. So moving averages are a stop and reverse system. So what that basically means is they're always in the market. They're either long or short. So they're either saying it's going up or saying it's going to go down. They don't stand aside. So you close out your long, your short. The next day closes above, so you close out your short and go long. Then about a week later it closes below. It doesn't quite close above, then closes above there. Then you'll be stopped out there for not any profit, and then long again there, good profit until your closes below there. Next day you reverse again, and you'll be out there. So hopefully you can see when the market gets moving like this great move we had after the US election, you get some good signals. But when the market goes sideways, and in this, we're only talking sideways for 2 or 3 weeks, we get a fair bit of chop going on. So the last signal, again, because we've had such a strong move in the S&P, the last signal we had, I think, would have been that one there. That's the last close through moving average. Let me just zoom in. So we would have been here on the 30th of August at around about, what, 24.55-ish, that sort of level, and it stayed long. So for the moving average to reverse today, the S&P needs to close below 24.72. I'm not saying it can't happen, but that would be a pretty big move. Again, as the market goes up, the moving average will track this higher. So that is a mechanical trading system. It's a very simple trading system using one moving average. Now, let's add another moving average into the mix. So let's scroll down. Simple moving average again, and we'll go with a 10 moving average this time. So 10. There we go. Oh, why's that gone to 20? Okay, 10. And the style, let's make this green so we can see it. Here we go. So hopefully you can see on your charts how this is different. Now, the 10-day moving average, because it's only taking into account the previous 10 days worth of prices, tracks the market much more closely. So it gets into trends quicker, so you get more action. So for example, 3rd of Feb, it was a buyer, stuck with it to here, the 6th of March, but then it gets messy because the market's going sideways. It's sort of reversing quite regularly and not making any money. And it's only when you get a decent swing again from here that the market's in. And again, if you look at the latest signals, it's actually, so it generated a signal the day before our 50-day did. So that the S&P moved above the 10-day there, 29th of August. But it also didn't maybe quite get out of it there, but got out of it here and then got back in again on the 27th of September. So that's using, you can see hopefully the difference between the slower moving average, the 50-day in purple, and the green one, the 10-day. But what I was saying is what some people do is they'll use the moving averages crossing over to try and filter out some of this noise. So let's go back to election day. So the green, the 10, crosses above the 50 on the 15th of November, so buys in here, sticks with it all the way to here, then goes short, but then reverses it here. So it went long there, around about 2400-ish, stayed with it all the way till here, where it reversed it off here, and then it bought back in again here, and it's currently long. So it doesn't appear to be too terrible. I think you filter out a lot of the sideways action. There's the chop. You still get choppy signals here, but not so many when you're using two together. So that's a 2 moving average crossover system. So as a rule of thumb, longer term moving averages like 50-day, 200 days pop in the stock market, you get fewer signals, but it keeps you out of a lot of the chop. But because it's a longer term moving average, it will be further away from the price, so you'll get into the bigger moves later. Shorter term moving average will get you into the price, into the moves quicker, but because it's closer to the price, you get chopped a lot more in false signals. And the combination of 2 moving averages together is to try and give you the best of both worlds. We'll just flip it over to an hourly quickly, then we'll get back to the markets. So there we go. There's no reason why you can't use them on hourly charts as well. But of course now my 10-day moving average, because I'm on an hourly chart, is now a 10-hour moving average. So it changes according to the time frame. So it's a classic trend following system. Works well when markets are trending. Doesn't work very well when markets are going sideways, but unfortunately we never know in advance when that's going to happen, do we? Okay, so there we go. So where were we? We were S&P 500. So S&P is still strong. Any weakness looks like a buying opportunity. I've been away for a couple of days this week, so I've not really watched stuff particularly closely, but here is the DAX. Okay, here's our DAX, and it looks like just today nudging out to fresh all-time highs. We had this, we had this sell-off in the DAX from June of this year, but these old levels held, and the market has pushed back up. So again, classically a breakout on the DAX through, let's round it up, through 13,000. Would be a classic chart breakout, suggesting the market's going to move higher. Like, with the S&P, we've not got much left in terms of support, but on the hourlies, a bit of support from earlier this week, sort of 12,850-ish, that sort of area. But again, still strong. These markets getting dragged higher by the US stock market. And for the FTSE, let's flip over to the FTSE. The FTSE is not as impressive as the DAX and the S&P, but it breaking out through the late August highs. Ultimately the target, if we're going to see the strength continue in these markets, would be a run back up to the all-time highs on the FTSE around about 7,600. I think that sort of area. I think that's maybe our logical sort of short to medium term target for the FTSE. Let's take a look. I just want to have a look at a couple of other markets that we don't normally look at, but I think are interesting. Where is it? Where is Aussie yen? I was looking at some FX markets earlier this week, and I thought it would be interesting to take the dollar out of it and look at something that wasn't correlated to the dollar. So here we go. This is Aussie yen. So I have actually done a trade on this today, but I thought it was interesting because what time frame is that? It's a daily chart. So we have seen some strength for the Australian dollar versus the Japanese yen. So the market spent April to June not really going anywhere, just sort of holding this 81.90 area. Then we saw the market rally sort of 700 points, sold off, had a little look below the old support, and has rallied again and hit sort of fresh all-time highs, not fresh all-time highs, highs for this chart that we're looking at in September. And the Aussies sort of backed off a little bit in recent weeks, but over the last week, looking at the price action and what's been going on with sort of big support levels, sort of 88 was support. It tried to poke below it on the 29th of September and it's held above. It poked as low as 87.95, and just over the last 24 hours it started to push out below this base. So I thought it was an interesting one to maybe have a little go on with a stop loss below the lows and seeing if we can recover back up to those old highs. But I tend to just look at the major currencies, but I thought to take the whole euro, the pound and the dollar out of the equation, I thought Aussie yen, sorry, was an interesting chart because some of the moves, and particularly this sort of false break where we didn't get any follow through and we are seeing some strength. So for me, I thought it was an interesting setup, given the fact there was a logical place to have stop losses so close. So I'll be keeping a close eye on that over the next couple of days. Let's take a look at gold and oil to wrap things up. So let's bring up the chart for gold. Here we go. So let's just remind ourselves for this what's been going on with this. So here's our daily chart of gold. I am surprised that it has pulled back this far, but let's just chuck some trend lines on and see where we are. So if we were going to go something like that, so the sort of 10-month recovery in the price of gold is still going, but this sort of correction from the 1360 area is still going as well. So I still think we're going to see a rally for gold back up to those old highs, but as ever the question is, how far is this correction going to go before the buyers come back in? So we've got lots of, I think, pockets of support left, all the way down. So from 1240, where the trend line is, all the way through to 1270, and we've seen something of a sharp move today. And I think it's easy to get sucked into maybe a sharp move like this and think, right, that's it, it's going to turn around. But I think patience still pays. So let's take a look on the hourly charts. So bearing in mind that 10-month trend for gold is up. This is what it looks like over the last month or so. So let's just pick this up. There we go. So I think this is a good example of how you can use different time frames to try and hopefully refine getting into something. The daily picture is bullish if you go back a year and a half, but the shorter term one is still pretty bearish. So this for me would maybe temper my enthusiasm about jumping in just yet. You know, we want to see it just stop going down, basically. You know, if I want to be a buyer, I want it to stop going down in the first place. I don't want to be the one trying to catch the falling knife. You know, and we've got, I think maybe the first obvious level to watch is 1290. I think if it could crack 1290, then maybe it is starting to turn around and we can get a bit more positive. But I think for now, let's see what happens. But I think it is interesting. We've got such a clear downtrend over the last month, but the bigger picture, you know, I think is still bullish. So I think it's an interesting one to watch, the price of gold. And we will. Oh, someone's asked about the Dow. We'll have a quick look. The Dow. I mean, the Dow is the same as the S&P. There you go. It's just going up, isn't it? It is just going up. The Dow. You know. So where's it gone from where we were on election time last year? 18,160. What is it now? 22. So it's what, 4,500 points. So it's 20% rally since the presidential election last year. That 20% is all down to Mr. Trump, obviously. Let's have a look on the hourlies on the Dow. You know, it's like the S&P. It's rallied so sharply over the last week. It hardly sells off. You know, so I think it's painful to be short. But it's definitely overdue a correction. But it keeps going up. And to wrap things up, crude oil. I think this has been an interesting market, oil, because these moving averages are starting to annoy me a bit now. But because of the strength we've seen over the last couple of weeks, I think this recovery off these June lows is still going. You know, so the price of oil looks like that. We were looking for much of this year at sort of that sort of thing, weren't we? Sort of a bit of a downtrendy, triangle-y doodah thing. Yeah. So you could argue that the correction that's dogged the price of oil since February this year, since the mid $50 a barrel mark, and has seen it as low as what, 40-ish, 42. That's over. So I think it is interesting that we've seen the price of oil actually manage a really strong recovery on the daily charts. And I think when we see this sort of thing happening, you know, it does suggest that we should be a buyer of dips. You know, as usual, the question is, how deep is the dip going to go? I think you know, the more conservative approach for stop losses would be below the last major low, so just ahead of 46. But that's $4 away from where we are now. I think maybe the more aggressive trade on oil. And don't forget, this afternoon we've got inventories, the US inventory figures that come out on a Wednesday afternoon every Wednesday, so that can cause quite a bit of volatility in the price of oil. I think maybe the more aggressive trade is to look to have stop losses beyond the level before it surged. So it's middle of September. Yeah, you can see it was dipping down to what, sort of 49.67 is the absolute level. So 49.50 to $50. Let's say we'd seen demand for the price of oil in there, and you know, it's had a push down into it yesterday and it's come off. So you could say the aggressive trade is a buyer now at 50.32 with a stop loss maybe at 49.32. So we've got a dollar stop loss, and if we think the market's going to ramp up, we've got maybe $2.50 upside back to those old highs. But I think it is interesting because of the bigger picture, and I'd always defer to the bigger picture. You know, the fact that it has cracked this correction that's been in place for much of this year. So I think it's a really interesting market now, and that for me would be the first level of support to watch for the price of oil, this sort of faffy around area from the second half of September. But even if it sells off deeper than that, like gold, there should be plenty of support, you know, on the daily charts further out. I think that's it. We'll start wrapping things up there. So I think there's lots to watch. You know, U.S. stock markets incredibly strong, dragging the rest of the world up. Well overdue a correction, but I bet there are plenty of people who have thought that for months and have missed out on gains and have been going short and getting toasted. You know, just incredibly strong markets. I think the euro, when it comes to FX, I think out of the majors, maybe euro dollar is one of the more interesting ones, because we've had weakness last week on the German election, a bit of weakness this week because of the Catalan situation, but this big 116 level has not been threatened. So I think that's, you know, maybe we'll see a bit of a push higher. And gold, because I think, you know, the longer term, bigger picture for gold is still up, but can it shake off this correction that's been in place for the best part of a month now? Okay, we'll see. we'll see. Plenty to keep an eye on. And of course, it's payrolls, isn't it? This Friday, I think, is US non-farm payrolls. So the US unemployment figures, every month they come out, due out 1:30 UK time this Friday. Always a big event, but it does mean, I think, that we can often have a fairly quiet Thursday and Friday morning until that happens. So let's see what that looks like when that comes out. But we will wrap things up there as usual. Any questions, feel free to drop me an email. I blogged about a real account, a real copy account with a couple of thousand quid in on my website, tradeafter.com, so you can read about the process and the performance of it there. It's definitely due an update. I have to pull my finger out and do that. But for this week, we'll wrap things up there. I hope you found it useful. Lots of stuff to keep an eye on, I think, and as usual, we will do it all again at the same time next week. So thanks for coming along, and we'll wrap it up there.